Welcome. My name is Geoff Driver, General Manager, Business Development and Investor Relations for Djerriwarrh Investments. I have with me today Mark Freeman, the Managing Director and Chief Executive Officer of Djerriwarrh Investments, and Brett McNeill, who's a Portfolio Manager responsible for Djerriwarrh within the team. So we just announced our result for the half year to 31 December 2021. And I guess a couple of key features of the result were the increase in income that we received, both from dividends and option income, and also pleasingly the ability to increase the interim dividend to 6.75 cents per share from 5.25 cents last year. So that was very pleasing. Mark, would you like to comment on the influence behind the increase in dividends that we received from the companies we invested in through the period, and what the outlook is potentially over the next 6 months for dividends within the market?
Yeah, we obviously had a good bounce back in dividends from the COVID impacted previous year or so. So that bounce back, we saw some better dividends from the banks such as Westpac, NAB, BHP dividend was very good. A few other stocks such as ASX Equity Trustees with some other examples of stocks where we had improved dividends. So I guess we're expecting that recovery, and it's been great that we've actually received it. Looking forward, we're hoping the stability in that dividend flow continues. Obviously, there's a couple of big influences on dividends overall from when you look at the Australian market. The banks are still a really important part of where people receive dividends from. We're hoping that those dividend streams stay robust. The balance sheets of the banks are looking pretty good, which hopefully sets up some good dividend flows. BHP and Rio are now big sources of dividends for the market. But obviously, those flows really do depend on the iron ore price, which is obviously very hard to predict. But if the iron ore price stays reasonably well supported, then we should continue to get good dividends from those companies.
Thanks, Mark. Brett, a pleasing feature of the result was the portfolio performance, which outperformed the index over the 12-month and 6-month period to the 31st December 2021, and also the generation of option income through the period. Can you sort of describe us how you managed the balance between those two factors within managing the portfolio over the period?
Sure. Thanks, Geoff. I mean, getting the balance right between income returns and the growth returns is essential for Djerriwarrh. And pleasingly, we were able to do it in this result. So we had a very strong portfolio total return, especially in a rising market. So on the 6 months, the portfolio was up 6.7% versus the market at 4.6%. Both of those metrics include the benefit, of franking credits. And on a 12-month basis, the portfolio delivered a total return of 20.6%, with the market, as measured by the ASX 200, at 18.7%. Again, both metrics including the benefits of franking. So that was a really pleasing result for the portfolio. And some of the biggest contributors in the investment portfolio, the stocks that we hold, were companies like ARB, Mainfreight, Car Sales, Sydney Airport, Goodman Group, and ASX over the different time periods. So that's on the stock side. On the options part of the portfolio, like you mentioned, it was a very good result, and it's a very important and active part of the investment strategy. So as a reminder, the option portfolio is managed daily, and it's managed from both a top-down perspective but also a bottom-up perspective. So top-down meaning we look to generate a certain amount of income to enhance the yield of Djerriwarrh, but not to the detriment of total return where we can avoid it. And bottom-up, that the option positions are managed with our assessment of the company's bottom-up quality, valuation, and also its recent trading price action. So as a quick summary of the way the options book was managed during the year, we had quite high portfolio call option coverage at the start of the financial year. So back in July and August, when the market was at high levels, the portfolio's call option coverage was high at 39%. And then as the market sold off a bit and then drifted sideways, we took the opportunity to close a lot of the option positions early to book in profits, but also to give the portfolio the benefit of any subsequent capital growth which we got. So we particularly did that in resource stocks, closing out a lot of our call option positions in BHP and Rio during that period. And then as the market sort of drifted sideways and then tracked up a little bit towards the end of the year, we rewrote some call positions selectively. So the call option coverage finished the period at 31%. But overall, it was a very pleasing result from the option side of the portfolio.
Thanks, Brett. Within that context, what were the major changes you made to the portfolio through the period? I understand, obviously, option exercises mean you have to sell some things through the period, but what were the sort of major changes that were made from a portfolio perspective?
Yeah, and it's a good point with the option exercises and necessitating a lot of the portfolio activity, because portfolio turnover is quite low in Djerriwarrh apart from the option exercises. But a number of our big holdings in the portfolio had share prices that performed extremely well during the period. So we're talking about companies like Macquarie Group, Telstra, Car Sales, Woolworths, ASX, Sydney Airport after the takeover bid. And we did get exercised on a lot of our positions in those stocks. So main thing what we do is take that capital and reallocate it into what we think are the best opportunities at that time. So we added to a number of our existing holdings, companies such as Commonwealth Bank and Westpac, but also Wesfarmers, and a number of positions in order to get that balance right between the income and the growth. We also added 4 new stocks to the portfolio during the period. So JB Hi-Fi and SCA Property Group were added primarily for their income, but also for their growth, whereas Cochlear and Domino's were added particularly for their growth potential. And we thought we were able to add those both of those companies in each space at quite good prices. So they were the main changes in the portfolio for the period.
Okay, thanks, Brett. So I guess we've started off the year or the calendar year with a fairly volatile start. Mark, have you got any sort of views about what's potentially going to happen over the next 6 months? And Brett, perhaps you might comment at the end about how Djerri operates within that sort of environment.
Yeah, obviously the start of this year's we've seen a lot of volatility, but particularly to the downside. And I guess in some way it didn't surprise us. We've been I guess calling out that stocks look pretty stretched to us towards the end of December. Valuations were getting pretty high, or very high. If you look historically at the markets, a couple of measures. One would be price to sales, another would be price to book of markets overall. They're all trading sort of at the upper end of their ranges. So it suggested to us that the market was pretty full. And we saw that through in what we have a preference for being quality companies, but even those were getting pushed to some pretty extreme valuations, and that just happens as part of the market cycle. We're not a trader as such. We want to be a long-term investor, but sometimes quality stocks can look good value. Sometimes they can look overpriced, but we tend to want to hold them. So I guess the pullback driven by concerns around inflation and interest rates, they're fairly well founded, and they have really caused I guess a bit of a mini correction, particularly in the high growth stocks. So in a way, I think it's quite healthy for markets to see some of those valuations come back. They were extreme. We've had a decent pullback, I think, of sort of something of the order, I think 7.5 or 8% in the market just in the month of January. So probably not a lot of surprise there. Interesting to see what happens. We go into reporting season as usual now. Now the market's made some readjustments, it's all going to be about earnings and outlook to drive the market from here. But, there's potentially more volatility because it looks like we will see interest rate increases out of the US and probably here in Australia as well.
And Brett, did you have any follow-up comments in terms of how Djerri's looking to operate potentially in that environment?
Yeah, well, the best thing to do when quality companies are at much lower prices is to buy them. That's a big part of our modus operandi, but you've got to have the funding to do it. And thankfully, we entered this period in quite a strong position, not just in terms of the existing portfolio holdings, but the balance sheet of Djerriwarrh. So we have had capacity to buy, which has been really good, and we have been doing that so far. So a lot of those companies that we spoke about that we got exercised on with our call option positions, and so reduced holdings during the period, particularly Woolworths, and a number of others. We've been adding to them. Macquarie Bank's another one. We've also been buyers of Car Sales, James Hardie, Wesfarmers, and picking up quite a lot of our existing holdings at better prices now, which I think sets us up really well for dividend income, and then subsequently option income when we start writing call options against those companies potentially down the track. And we're also looking at potentially a couple of new opportunities as well. There's some really high quality companies out there listed on the share market that we don't own, that we've had reservations around valuation, like Mark spoke about. And some of those companies are starting to come back to prices where we think they do represent long-term value. So you might see us add 1 or 2 companies to the portfolio in this period as well.
Okay, thank you, Mark and Brett, for your time, and we'll talk to you again after the next profit result. Thank you.